Hello, AP Macro students, and welcome back to another AP Live video. My name is Matt Romano, and today we're going to be doing some FRQs with an emphasis on Unit 5. So let's talk a little bit about Unit 5 first. What was Unit 5 exploring? What was Unit 5 all about? What was the emphasis? And what are the topics involved? Here, obviously, are your topics that are involved here. But Unit 5 it's a really cool unit because it's really, and the description even says it in a moment, you'll see, it's a culminating unit when it comes to learning about the closed economy. Because at this point in the curriculum, when you think back, you're still in a closed economy. Unit 6 is where you open it up, and of course, Unit 6 will not be on the 2020 exam. So this is the culminating unit that really ties everything together, and it's hopefully where you start to see it all come together. As I said, the why we studied the three indicators that we studied so much in Unit 2, and why we did so much with ADAS and fiscal policy, and why we did so much with monetary policy and banking, and seeing both in the short run and the long run what happens when we put it all together. So it's a really interesting, it's a really fun unit for that reason. And the questions we're going to do today as practice are going to really put an emphasis on some of the topics that were introduced within Unit 5. But that said, it was all introduced sequentially as you learned it in Units 1 through 4, and then we put it all together here in Unit 5 to see how it applies. And that brings up the next thing I really like about it. It's such an applicable unit. This is stuff you're going to see in the news. You're going to see this stuff in political campaigns, government debt and deficit. You hear about that all the time. Right now, you hear about it, money growth and inflation. You hear people talking about that in response to the monetary policies that we've been witnessing recently. So all of this is in the news. It's applicable. It's relevant. And I hope you appreciate that from this curriculum and this section of the curriculum. What do you need to know from Unit 5? What are we looking for when we're answering these questions as it pertains to Unit 5? Let's start with the big ideas and essential questions. And once again, looking back on this, now that you've covered all the material and really thought about it in depth, you'll see this in the context, and you'll see kind of foreshadowing from these essential questions. How does an economy grow? What again is meant by economic growth? It's not just output increasing in the short run. It's not an increase in aggregate demand or SRAS. Remember, economic growth is an increase in the productive capacity of an economy. We're talking about GDP per capita. So we've got to have some connection there to productivity. We've got to have some connection to capital formation, the development of new capital. That's what it means for the economy to grow. Think PPC, think LRAS. What's the relationship between inflation and unemployment? Of course, you're looking back on this now. You know exactly what that's referencing. We're talking about the Phillips curve there. So we're going to look for that in the questions we answer today. How do monetary and fiscal policies affect the economy in the long run? Really have two things you can pull out there. There's crowding out and there's quantity theory of money. Crowding out, of course, we're going to see that. We're going to see how that can be asked in the context of an FRQ in the previous year's exam. The quantity theory of money, we'll talk about that a little bit as well today, and how we can see that connection in the long run between money supply, changes in money supply, changes in price level. Developing understanding, not going to read this whole thing to you, but again, they use the same words I did. This is a culmination and an extension of what's been introduced in Units 1 through 4. So you're taking that knowledge of ADAS, of major macro indicators, of fiscal and monetary policy, and we're building on that and extending that, going a little bit further with it so that we can look at economic growth, we can look at the Phillips curve and understand what we're talking about. What skills do we need? As always, we've got to be able to explain a specific outcome, whether it's from one event or more than one event, more than one variable. We've got to be able to, again, determine the outcome of a situation using the models that we have learned. We want to be able to determine the effects of one or more changes. And normally, skill 4B would apply. We would demonstrate what we have learned on a graph. You should be able to do that, obviously, but again, let's put it out there. We're not going to be doing that on the 2020 exam. You should expect to have to explain what's happening in a model on a graph, and obviously have some scratch paper out as you're taking that exam. Even though it's not something you'll submit, you might want to draw up some graphs, and for your own understanding, draw up some graphs and show those changes for yourself to help you interpret what's going on in these different scenarios. Essential graphs, we had one new graph. Obviously, all graphs are fair game by the time you get to Unit 5. ADAS is still a major component of everything we do. But this was the unit where we introduced the Phillips curve. So just a reminder of what the Phillips curve is. We are illustrating here the relationship between inflation and unemployment in both the short run and the long run. We have a downward sloping SRPC. So in the short run, we have a negative relationship between inflation and unemployment. That's a trade-off. There is a trade-off in the short run, but in the long run, there is no trade-off. We have a vertical line, and that natural rate of unemployment is not impacted by changing rates of inflation. The equilibrium we've shown here obviously is a long-run equilibrium. That's the inflation rate that we would anticipate in the long run and the natural rate of unemployment. But as you well know, we're not always in the long run. A lot of times short-run equilibrium is somewhere else. So if we're operating on the right-hand side of the SRPC to the right of the natural rate of unemployment, that means unemployment is greater than the natural rate. And that means we have a recessionary gap. Think about what that looks like on ADAS. If we're operating over here to the left, then unemployment is less than the natural rate, and that means there's an inflationary gap. So you hear it said many, many times, it's a mirror image of the ADAS model, and this is somewhat of what that means. That's an extension of that description. We're going to use that today, so keep that in the back of your mind. Formulas. We had one formula, the equation of exchange. The equation of exchange is always true. There is no dispute about that. We use this equation to illustrate the quantity theory of money, something I already brought up once today. Of course, this is the equation, MV equals PQ. Sometimes you'll see it as MV equals PY, means the same thing. M, of course, is money supply. V is the velocity of money, how many times each dollar is spent in a given year. P, as we know, is price level. It's an implicit price deflator. It's a representative of price level. Q, or Y, represents real output, real GDP. Either side, when you multiply M times V, or if you multiply P times Q, you're going to get nominal GDP. Keep that in mind because that does come up pretty frequently. And then finally, like I says up here, we use this to illustrate the quantity theory of money, which tells us that in the long run, price level is going to move in direct proportion to any changes in money supply. So we make that connection between changes in money supply, changes in price level. Okay, so that's the basics of Unit 5. That seemed kind of quick, but really that's because it's the culmination of everything else that we have done this year. So keep that in mind. Everything is fair game. Let's jump into some questions. First question we're going to look at, 2016 question number 1. So this is the time that if you're watching this in a recorded version, you want to go ahead and pause, answer your question, come right back and we'll walk through the answers. Those that are watching with me live, we're going to take our time and walk through this question. So I want you to have some paper and write down your answers as we go. All right, remember that first sentence is always important. It's going to be something in that first sentence that we need. So read it carefully, highlight it if you can, or jot down some notes. This year, it's probably best to jot down notes and think about what relevant information are they telling me. Assume the US economy is currently operating in a short-run equilibrium with the actual unemployment rate above the natural rate of unemployment. Okay, I think we know there's some foreshadowing. There's something in there we're going to have to use, and it's pretty obvious. Let's talk about part A. Draw a single correctly labeled graph with both the long-run Phillips curve and short-run Phillips curve. Label a current short-run equilibrium point P. Okay, we just looked at this. We just looked at this as the essential graph, short-run, long-run Phillips curve. I want to draw the graph. I've got to know how to draw it in terms of each axis, obviously, what the curves look like. But I have to show a short-run equilibrium. What do I know? What information has been given to me that's going to help me correctly identify short-run equilibrium point P? Go back up here again. In that initial prompt, the actual unemployment rate is above the natural rate of unemployment. It is greater than the natural rate of unemployment. So if I'm going to throw out a number. If the natural rate of unemployment is, say, 4%, the actual rate of unemployment is something greater than 4. So I know that much. Unemployment is currently greater than the natural rate. That means we're operating with a recessionary gap. If you were drawing ADAS, you would illustrate a recessionary gap. How do I show that on a graph of the Phillips curve? That's the question. 2-point question here. First point you would earn simply by drawing the graph and having everything labeled correctly. So we have to have the inflation rate on the y-axis, unemployment rate on the x. We have a vertical long-run Phillips curve and a downward sloping SRPC. The second point is by identifying point P. It's got to be on the short-run Phillips curve, and it's got to be to the right of the long-run Phillips curve. Again, consistent with what we see in the prompt, the actual unemployment, which is what point P is indicating, the actual unemployment rate is greater than the natural rate of unemployment. So 2 points there for your graph. Now, again, this year, you're not going to submit graphs, but doing that as you practice is going to help you for whatever you're going to face on test day this year. Part B, assuming no policy actions are taken, will the short-run Phillips curve shift to the right, upward, shift to the left, downward, or remain the same in the long run? Explain. Okay, once again, read and understand the question before you start answering. You've got to make sure you've got to put yourself in the question and know what it is they're asking you. So they start off by saying, assume no policy actions are taken. Okay, in the long run, we had a recessionary gap and there's no policy action taken. Remind yourself, recessionary gap, right? What's going to happen next? What is this question about? Identify the concept, identify the topic. This is a long run self-adjustment question. How do we get back to long run equilibrium? And what does that look like when we're dealing with the Phillips curve instead of aggregate demand, aggregate supply? If it were ADAS, what would happen? Well, SRAS would shift to the right because we had a recessionary gap. What does that tell us about the short run Phillips curve? Short run Phillips curve will shift to the left. And you've got to explain, that word explain is up there. So I've got to explain, I've got to give a sentence that provides a causal relationship. Explain that producing at a level of output below full employment will create higher unemployment, lower inflationary expectations that will result in lower nominal wages and input costs. So I've got to make that connection. SRPC is going to shift to the left, but my reasoning really comes from the self-correction that we learned about from the ADAS model. You've got to make a connection between those concepts. You've probably learned either from these videos or certainly from your teacher, SRPC is going to shift the opposite direction as SRAS, and that's a healthy way to look at it. This is where you use that information. All right, so SRPC is going to shift left. We're going to wind up right back at long run equilibrium, and the reason for it is what's listed right here. All right, that's part B. Moving on, part C and D. Put these two together because they go together. They're both referencing monetary policy, and of course, D refers back to C. If the Federal Reserve Bank wants to lower unemployment, what expansionary open market operation should it use? So once again, we're dealing with a recessionary gap. How's the Fed going to lower unemployment? This says right here it's expansionary. You've got to give an open market operation. And this is, again, where a lot of students make a very common mistake and they state a policy that's not open market operations. Correct answer for C, 1 point earned for stating the Federal Reserve should buy bonds. That is the only possible answer here. They've got to buy bonds. They've got to purchase securities. You cannot make references to discount window lending. You can't make references to reserve requirement. That's not open market operations. And that's a common mistake, and we want to avoid that. Make sure you read the question and you answer the question that's being asked. Part D builds off of that. How will the open market operation you identified in Part C affect each of the following? The federal funds rate, explain. The real interest rate in the short run. All right, start with the federal funds rate. Recall what that is. That's the overnight rate that banks charge one another. We want to say what happens to the federal funds rate and explain what happens, and then carry that over to the real interest rate. So for the first, for D1, 1 point is earned for stating the federal funds rate will decrease and for explaining that the money supply will increase, which will increase reserves and decrease the Fed funds rate. For part 2, D2, what happens to the real interest rate in the short run? 1 point is earned for stating the real interest rate will decrease in the short run. And that's all you have to say. This is an identification question. This is not an explain point. Simply state your answer and move on. On to part E. So E references part D2 specifically. Given your answer in part D2, what is the effect on real gross domestic product in the short run? Explain. So I've got to identify first what happens to real GDP, and then I've got to provide some causal relationship here. I've got to explain why that happened, whatever it is I stated. So thinking back to part D2, I'm going to pull that one back up. What did we say in D2? We said that the real interest rate will decrease in the short run. That's my prompt. I have to base my answer on that. If you choose some other reasoning, you're not going to get full credit. You've got to base it on the prompt that you're given in the question. So because I'm basing it on this, that's all I have to go off of. The correct answer is real GDP will increase in the short run. A decrease in the real interest rate will increase interest-sensitive spending, which includes consumption and investment in plant and equipment, resulting in an increase in aggregate demand. All right, so again, use that ADAS model. That's what it's there for. You didn't have to draw it, but use that model to help you come up with an explanation. I see that real interest rates gone down. I'm going directly to those shifters of aggregate demand because I've already made a connection in my head between changes in interest rates and changes in specifically investment spending, but also consumption. Consumption, some level of consumption is driven by interest rates. It's interest sensitive. So that could also lead us to an increase in aggregate demand. That is going to lead to an increase in GDP, and that's your answer. All right, that's 2016 question 1. Let's try another. 2010 question 1. So we're doing 2 long questions, 2 question 1s. Now this year, this format for question 1 is actually going to be what you see on the second question, the 15-minute question. Question 1 this year is going to be the combination of questions 2 and 3, the shorter questions we've been working on all along. Let's read through it first. And again, if you're watching the recorded version, now's the time to pause, leave this up on your screen and answer the question. Those that are watching live with me this evening, we'll walk our way through it very slowly, give you a chance to jot down notes and hopefully sketch out your graphs. Assume the United States economy is currently in long-run equilibrium. I bet I'm going to need to know that. Let's work our way through. Part A, draw a correctly labeled graph of aggregate demand and aggregate supply. Show each of the following: the long-run aggregate supply curve, the current equilibrium output and price levels, labeled as YE and PLE respectively. All right, so again, what do I need to know? I've got to know that we're at long-run equilibrium. That's the first step. I've got to know my starting point, and then simply follow directions and draw your graph. So here, 2-point question. 1 point earned for drawing a correctly labeled graph with a downward sloping AD curve, an upward sloping SRAS curve, and the points PLE and YE on the vertical and horizontal axes. Remember, you've got to connect those back. Well, I guess that doesn't matter this year, but you do need to connect those back to your equilibrium. 1 point earned for showing a vertical LRAS curve at YE. Again, we're at long run equilibrium. All 3 curves intersect at the same point. So you've got to show that here. Okay. Moving on to part B, and I left the graph up because as you'll see right here, we're going to use this graph in our next part. Assume the government increases spending on national defense without raising taxes. All right, again, let that process a little bit. Government spending is going up. There's no change in taxes. On your graph in part A, show how the government action affects aggregate demand. Part 2, how will this government action affect the unemployment rate in the short run? Explain. So I've got to show it on my graph. That word show is a verb. I've got to use that. And then I've got to process that and say, how's it going to affect unemployment? Again, pretty straightforward. Government increases its spending. Government spending. That's within CIGNX. That's an aggregate demand shifter. They told you aggregate demand. Aggregate demand is going to shift to the right. So the first point, 1 point, is earned for showing a rightward shift of the AD curve on the graph in part A. Second point is about unemployment. 1 point earned for stating that the unemployment rate would fall and explaining that this is because real output increases. If all you did is say unemployment falls, you don't get the point. You have to explain. So that explain point is very important. Practice that. You're going to need to practice that because you've got to be able to verbalize things this year because you're not going to have graphs to fall back on. So be sure you can verbalize these things. Do some of the practice questions that are on AP Classroom. You'll find them under optional student practice. I'll show you the link again at the end of the lesson here today. All right, that's part B. Let's move on to part C. Assume the economy adjusts to a new long-run equilibrium after the increase in government spending. Okay, hold on. So go back. Here's where we just were. The government spending pushed AD out to the right. We had some demand pull, inflation, and now we're operating beyond full employment. Okay, we need to have that in mind. So we're operating beyond full employment. Now they say assume they adjust to a new long-run equilibrium after the increase in government spending. What again are they implying here? They're implying long-run self-correction, long-run self-adjustment of the economy. They're walking you through the process. You just have to provide the correct answer and shift. How will the short-run aggregate supply curve in the new long-run equilibrium compare with that in the initial long-run equilibrium part A? Explain. On your graph in part A, label a new long-run equilibrium price level as PL2. If I'm answering this question, I actually want to do part 2 before I do part 1 because I want to see it on a graph. And then that's going to give me the answer to part 1. Here's what we have. 1 point is earned for stating the short-run aggregate supply curve will shift to the left, showing PL2 correctly on the graph at part A. So SRES shifts left. We know that's long-run self-adjustment. We were operating beyond full employment. Wages are going to adjust upward. Resource prices are going to go up beyond just wages. Resource prices are going to go up. So we're going to see a decrease in the SRES curve. It shifts to the left. Cost push inflation. We go up to PL2. 1 point is earned for explaining the actual price level is higher than was expected, or that wages and commodity prices adjust to the higher price level, causing SRES to shift to the left. So again, we have to show that PL2 as being higher than PLE. Part D. In order to finance the increase in government spending on national defense from Part B, government borrows funds from the public. Using a correctly labeled graph of the loanable funds market, show the effect of the government's borrowing on the real interest rate. All right, so we're dealing with 2 different models in this one. We had ADAS already. Now we're going to go with the loanable funds market. That can happen. Don't be surprised by it. In fact, welcome it, because those graphs are going to help us visualize what's going on. So how do we show that government is borrowing money on our loanable funds market? The standard interpretation of that is that borrowers are on the demand curve. There are alternate interpretations that could be accepted, but the standard AP interpretation is that borrowers are on the demand curve. Therefore, we're going to draw our graph and we're going to show a rightward shift of demand. Demand shifts to the right, and that's going to show an increase in real interest rates. Points for this question: 1 point earned for a correctly labeled graph of loanable funds market. What does that mean? Real interest rates on the y-axis, quantity of loanable funds on the x, upward sloping supply, downward sloping demand. Got to show equilibrium. 1 point earned for showing a rightward shift to the demand curve, resulting in a higher interest rate, or here's that exception, a leftward shift of the supply curve, resulting in a higher interest rate. That is also an acceptable explanation for the effect of government deficits. All right, we're going to use that. So keep that in mind, what just happened there, because moving on to part E, we're going to use that. So we just had an increase in demand. We had an increase in real interest rates, and we move on to part E. Given the change in real interest rate in part D, what is the impact on each of the following? Investment, economic growth rate, explain. So what happened to real interest rates? Real interest rates went up. That's what happens as a result of deficits, as a result of government borrowing. Interest rates went up. And as interest rates go up, investment spending will decrease. What does that sound like? Government just borrowed a whole bunch of money in the loanable funds market, driving up interest rates, reducing investment spending. That's crowding out. The words weren't used here, but it's helpful for you when you're making connections to connect. This is what crowding out is. Public borrowing crowds out private investment. If and when that actually occurs, that's what crowding out looks like. What's the long-term consequence of this? Why'd we bother learning it? Part E2, economic growth rate. 1 point is earned for explaining that the decrease in investment slows down capital formation, leading to a reduction in the economic growth rate. I put a box around that term, capital formation. That's such a key term. You don't have to use those exact words, but when we're making that connection between investment spending and economic growth, if you're going to explain it, you need to have some reference to capital formation, development of new physical capital, capital accumulation, something to that effect, because that's the connection between investment spending and economic growth in the long run. So when you have to explain economic growth, think capital formation. All right. That's the trade-off that exists when we have crowding out, if and when we were to have crowding out. Okay, you're gaining a little bit in the short run thanks to the fiscal policy and the borrowing, but it theoretically could slow down economic growth rates in the future. Capital formation, remember that. Okay, on to debrief and summary. That was all of Unit 5. Those were 2 questions that did a really nice job of illustrating these topics. And hopefully you saw how this really does bring together all those topics we've been doing throughout Units 1 through 5. It's practical, it's very relevant. So just again, make sure that you're up to date on it. And if that wasn't clear through these questions, and go back and look at those rubrics again and go back and review the topics as much as necessary. But that's how we typically see Unit 5 applied in an FRQ. I want to remind you of the optional student practice in AP Classroom. Log in, and when you log in, you should be able to find it right there on the left-hand side. Practice answering FRQs. We're going to have more resources available in the very, very near future, and we will talk about those next week. So keep an eye on AP Classroom. There's a lot there that really is designed to help you not just have an opportunity to take this exam, but to help you prepare and reduce the anxiety going into exam day. Because this format is so different, you'll be excited to find there's a lot of new stuff, not a lot of new resources available for you to help you get a sense of what exam day is going to feel like. Finally, I just want to mention this was our last FRQ practice day and last lesson in that format. Next week is going to look a lot different. And the way it's going to look, this is the schedule, is that we're going to offer up 2 days of timed practice exams. So on Monday and Wednesday, we're actually going to use this time to practice taking an exam. Just to see what it feels like to have that 45 minutes and 25 minutes for the first one, 15 minutes for the other one. Enough time to submit everything, just to give yourself again the feel of what it's going to be like. We'll take Tuesday and Thursday to review the questions that we answer on Monday and Wednesday, and then Friday we're still working on it, but the plan for Friday is to send you off with just a whole host of exam day tips, just suggestions from ourselves and other AP teachers about what works best. What things can you do between next Friday the 8th and exam day on the 21st? What can you do to best prepare yourself so that when you take the exam, your best effort comes out? Because that's what it comes down to. If you put in the practice, if you put in the effort to prepare yourself, exam day should be fun. You should go out there and do your best and hopefully reap the rewards of a lot of hard work. Okay, that's it for today. I want to thank you for watching. I want to thank you for the effort you're putting into this class. It is appreciated. I do wish you well. I hope that everything pays off down the road, and come back next week and we'll just keep making progress and try a couple of practice exams and see how it goes. So have a great weekend, and hope you come back next week.